Let's go to the next part. List of disallowed expenses written in Article 33, 12 item. The same we are discussing the 12 item. So here we already seen the last point. Just for quickly, I'll just go back. The fourth point, the entertainment. Fourth point, entertainment, we already discussed. Now we're gonna move to the fifth point. This we continue. Now we're gonna see the fifth point of the 12 out of 12 item. Drawing of goods from the business for personal use. I appreciate if you guys reply what are the drawing, what is the definition of drawing, and how you, what is the understanding that you guys have, what is the accounting treatment we will do. What would be the adjustment in the financial statement? What would be adjustment? Where will make this adjustment? What is the normal practice? What is the normal practice that mostly in not the big companies, but SME companies or the sole establishment or sole proprietor or LLC companies where 2 or 3 partners, what is the practice over there? What is the practice over there? If somebody owner or the connected person or any one of the owner's son and came and take some, if they are in the food item, they might take some eatable item with them at home. So Muhammad Adnan is saying he's charged to gift. So he's every day taking food and give to his family and put as expense. Somebody else. I appreciate your response. Mr. Nasser, yes, you are saying correct. Can it be purchase cost? Anyhow, let's reduce to the extent of the amount of drawing. Yes, assets. Okay. Let's understand what would be the effect. What would be the effect for the tax purpose and where would be the effect? Example or illustration, drawing amount is a 5,000. Here we have to understand the drawing amount is a 5,000. What is the example? Income statement, the sale is shown the 100,000. And how we calculate? The cost of goods sold? Normally in the financial statement, we are familiar how we are doing opening inventory plus during the year purchase plus the closing inventory. So this is the formula we are applied to calculate the cost of goods sold. This is the formula we applied. The closing inventory is a 10,000 and now the 60,000. So the net profit will be 40,000. Net profit will be 40,000. But here we written the 45,000. Why? Because we here mentioned the closing inventory is a 10,000. System is shown the closing inventory is a 10,000. But at the year end, when you do the stock count, but you found the inventory value only 5,000, not 10,000. Upon the further investigation, you found that balance 5,000 inventory or the material or item, cloth or whatever the garments or whatever the nature of the industry or nature of the inventory, the owner or owner's son taken at home. But there is no records, there is no entry, there is no bookkeeper because no one stopped to the owner or owner's son also don't take, this is the business property, you cannot take, nobody stop him, nobody make any adjustment, nobody record any expense. But actually now our inventory is the 5,000, what we do? So we have to add back the 5,000, okay? The add back, what is the add back? Because we earlier we said our inventory is a 10,000. So 10,000 is minus, but now our inventory is the 5,000, which means here you have to less only the 5,000 instead of 10,000. Instead of 10,000, you will minus only the 5,000. That's why we mention here plus 5,000. What is the plus? Because closing inventory minus 10,000 plus the drawing plus 5,000, net is the 5,000. So the effect will coming 45,000. So now what will happen? Our gross profit is increase. Earlier, without drawing is coming 40,000 and with drawing adjustment is coming 45,000. This is the area where we have to adjust. This is the area where we have to adjust. Okay. Now the other normally we already discussed what to do, how to do, but this is the income statement where we need to make the adjustment and show the because what we are trying to understand here, this 5,000 is not the business expense. This 5,000 is not the business expense. Because if you record as expense, so your tax base will be reduced, your accounting profit will be reduced. You might consider drawing as expense in the accounting, but tax authority is saying this is not business expense. This is not the business expense because this practice, if continue, so most of the tax person, they have this practice. In certain industry, they can use the similar fashion. I know I have one of the client where they are dealing in the the luxury car. They are giving the rent a car, but normally rent a car for luxury car they use only 2 to 3 years, not more than that. After that, they sell out the car. So they always have the new brand, new models, the car. So what they will do, they even if such more than 100 cars, the luxury cars, they have it. So what they do, they purchase the car because if they purchase, even the family or the owner or the connected person, they use the same cars for personal use. Actually, they are buying for personal but under the business name. So if they are recording under the business, so they are claiming back the VAT also because every year they are changing. If they every year they purchase for personal use, they cannot claim back the VAT. So just imagine the one car value maybe the approximates 800,000, approximate 500,000, 300,000. These are the all luxury cars where the customized car, the advanced cars, the model cars. So even the average amount, we say the 200,000, how much the VAT amount? If they put under personal, they will lose that VAT amount also, but they are putting under business and they keep using for personal also. Even they purchase for their family members, but they're recording in business. So such expenses, we have to highlight, we have to ensure if any expenses belongs to the owner, we will not deduct from the taxable income. Even in accounting profit, we already deducted. So here the GL accountant or the accounting team, he have to put some information in the chart of account. At the transaction level, he will highlight, okay, these are the expenses as per the tax is not the deductible. So this is the role of the GL accountant. If he knows the tax, if he's familiar with the tax regulation, it will help to improve the reporting. It will help to improve the compliance also. It will help to optimize the taxation regulation also. And to ensure the tax return filing also. These are the key area that is required. As of now, your amount is recoverable, not recoverable. That is another topic. We will know if the owner are using the cars for personal, how to bifurcate. See, these are the very gray area, very gray area. The example what I shared, this is the very common and it's apparently seems they are buying for the personal. But in certain area, where the owner is using for the personal as well as for the business also, you can make the company policy what are the certain amount is using for the business and certain amount for the personal. But before that, Another point we have to look over here. If the owner, I'm gonna give you example. Owner will take the car for him only because he's the share MD, managing director or managing partner or chairman. So if he's the on genuine case he's using the car for company, yes, it would be allowable expenses for the juridical person on arm length basis. But if the same owner or the person is giving the car to his wife also, although they are not working, so what will be the rationale on that? That's one thing. This is the gray area. You have to be very careful and understand. Yes, you can deduct as per, or if the CEO, because the CEO salary also will be deduct. You are paying the CEO, chairman, whatever the acting partner, you are paying the salary also under the LLC or juridical company that also deductible as per the ALP road market value. So this the company car also provided as a company allowance, traveling allowance, transportation as per the company policy. Yes, it would be deductible, but how much if you give to his wife, his to son, then you have to see the rationale behind that. How you can justify on that. Hope this point is understand. This is the point that you were asking. This is the point. Reasonable apportionment. And the owner using car or son is using car, who's actually now here reasonable apportionment, but because on case to case, on maybe the same expense for the one entity is a different, another entity is a different case. So here the word is a reasonable apportionment. So we may say the 50-50, we may say the 60-40, we may say the yes, Rana. Here we are making the reasonable apportionment. Yes, if here we have to see what are the accounting standard, what is the accounting standard guideline, what are the accounting standard guideline, but as per the what are the company policy, but as per the city law, again, are this benefit for the juridical person, for the LLC company, make sure this is not applicable to the natural person, this is not applicable to sole establishment, this is not applicable to the unincorporated partnership. All this point, the question your Ms. Farana is highlighting, this is not available under that scenario. But for juridical person, yes, these are allowable. You can deduct on arm length basis. On arm length basis. Okay, now we see the another part. Business usage is allowed, private usage is allowed. Where the personal limit included into expenses. Here the same, the car expense, telephone expense. So maybe we already, as per the VAT, we already have some company policy. We have some allocation, the 70-30, 60-40, or 50-50 for the car use and the telephone use. So we may keep the same over here also. So here the word reasonable apportionment, because the burden of proof on you, because taxable authority may ask, okay, what is the rationale? What are the reasonable apportionment? Why you allocate in this way? Why you deduct this expense? We have to prepare our rationale behind that. We have to do our exercise. Next, move to the next. Point number 7 out of 12. Recoverable input VAT expense, recoverable VAT, irrecoverable VAT. Here the point, irrecoverable VAT is allowed and recoverable VAT did not claim. Recoverable VAT, but we forget to claim in the VAT return disallowed. We cannot, in accounting we put as expense, but under the city competition we cannot deduct. We cannot deduct. Irrecoverable VAT example, restricted vehicle, 1% private use, entertainment expenses. Okay, restricted use, 1% private use. So we may be seeing that example before also, but let's see. Yes, these are deductible, but VAT guidelines are there. Please follow the VAT, have very public clarification on such areas. Follow that. If you follow that, for sure it will comply in the city also, because the VAT public clarification is there on this area. Please go through and do the appropriate understanding and apply on that. But as concern for as city law, yes, is a deductible on arm length market value basis. This is the city law is saying for the LLC and the natural person for unincorporated partnership for employees. All these expenses are deductible. Only the owner salary, CEO salary in the natural person and the unincorporated partnership, that is not deductible. Here we see the purchase the 100 and the input VAT is 5, cash paid 105. While making the transaction or recording the transaction, our bookkeeper, they did not record this 5 as a VAT input. It put a recorded as expense, but this expense is the claimable. Okay, but if you did not claim, so then we cannot record as expense. So this is the example, recoverable and unrecoverable. Let's move to the next one. This we already go through the previously in detail. Expenses incurred on the non-taxable activities. Expenses incurred on. Here is another technical point. Here is another technical point. Expenses incurred on non-taxable activities, which means maybe there is some activities that is exempt from the city law, out of scope from the city law. Here in accounting, if you guys, I appreciate if you respond. What is the matching concept? What is the matching concept? Please, I appreciate quickly respond on the matching concept or accounting principle. Guys, quickly please respond on the matching concept because this is important to understand. Okay, guys, most of them giving the correct answer and they have the correct understanding. Okay, here by using the same what we're understanding, the expenses and income should be booked in the same period. Now here we're saying expenses and income should be booked in the same period. Take the same understanding and see if we are saying the expenses and income book in the same period for the matching purpose, but here if the income itself is out of scope, can we deduct that expenses from the city computation? If income is not falling under the tax, income is exempt from the tax. So accordingly, the expense belong to such income, will be expenses belongs to such income who's exempt from the corporate tax, not non-deductible. Okay, so we have to see maybe in the accounting team, they already record these expenses, they already deduct these expenses and they reduce the accounting profit. They already reduce this profit. So we will, if we are excluding the income, we have to exclude the expenses also. We have to add back such expenses also. Hope this point is also understand. Here we are giving the example like broker fee, commission fee. If we buy the shares, yes, Ms. Vanna, okay, I'll give you the, let's continue, keep the under 8 point. The 8 point, okay, I'll give you the example for the shares. I'll give you the example for the share. If we buy the shares of the local company, if you buy the shares of the local company, so and you get the dividend on the such share on the annual basis. So now in the previous session, we understand the dividend from the local company we receive is a taxable. Ms. Rana, please give me the answer on that. Okay, guys, this not taxable. Okay. If the dividend is not taxable, so whatever the expenses incurred to buy that shares, that would not be deductible. Because you buy the share of the local company through the broker, through the banks, Okay, the IPOs. Most of the major banks are they offering the brokerage services. So when you buy the shares, they will charge the brokerage fee, commission, legal fee through the broker, and their service fee. And when you sold out, they again will charge you. So all these services, if the on that income from that shares or that dividend we are saying is not deductible or not taxable, then these expenses also will not be deductible. These expenses are not be deductible as the income is exempt. Accordingly, the expenses will be disallowed. Accordingly, expenses will be disallowed. Yes, Farhana. Hope you understand the point number 8. Hope you understand the point number 8. Please quickly, please quickly. Now I'll come back to the point number 7 again. Here what I'm saying, okay, give me the example of any VAT that is we cannot claim back from the FT. Quickly give me any of the example that coming in mind. Yes, this is the VAT we paid, but we are not claiming from the FT and the VAT return. Or any other person, any other person. I appreciate if any other person can give me the example. Okay, here the penalty, one of the word is used, fines. Okay, if you paid the penalty, so that now the penalty also will be a gray area, because if we take the example, there will be penalty another topic in the VAT, because the penalty if you paid as a contractual term, that story will be different. The fine, the word fine, if you paid, you made the violation of the law, and you paid the some fine on that. No word on the fine on that. Let's assume that any other example, if you guys are give me any other example, I'll take that. Okay, I'll take the entertainment expenses. VAT is recoverable on entertainment expenses for the employees. And how about the other stakeholders? For the if we give the entertainment to the customer, to the supplier, the VAT is claimable. Please answer quickly. If we paid the VAT, Mr. Khalil is saying not claimable. If you're saying not claimable, so how if we say irrecoverable VAT? Mr. Khalil is saying not claimable, so I said, can we name in the irrecoverable VAT? Let's keep the same example. If we spend the entertainment expenses for the other stakeholder apart, not on employees, apart from employees, on stakeholder suppliers, or this is not for business purpose, so this is not claimable. So can I see the not claimable is irrecoverable VAT? Ms. Farhana, would you please respond? These expenses that we are seeing not for business purpose are the other stakeholder, we paid the some amount and the VAT is not claimable, is called irrecoverable VAT. Yes, if this is the case, then in city computation, these expenses will be allowed. We can deduct these expenses. Normally in accounting we already deducted. in accounting, we already deducted all these expenses from the accounting profit. So in that is, if we already deducted, is allowed. Is allowed expense. Okay, just keep the same example for understanding. We will. Okay, now the another part. Now here we are saying the recoverable VAT did not claim. Here you buy some goods for the business purpose, some inventory for business purpose, but which means the VAT can be claimed. But the bookkeeper, they did not put the unclaimable VAT. What he did, instead of making the entry purchase 100 and VAT 5 and cash is 105, what he did, he put cash 105 and purchase 105. He did not apply he did not record the input VAT. So by mistake, he put the input VAT also as a expense, as a purchase cost. He increased the purchase cost. So this is recoverable VAT by due to some mistake or maybe the forget, you did not claim. So these VAT is a disallowed. So this VAT you already put as an expense. Now the city as per city, they're saying you have to add back. You have to add back. This is the disallowed. This is the disallowed. You have to add back. Guys, hope this point number 7 and 8 is clear. Please quickly respond on that. Please quickly respond on that. We are spending too much time on that. Thank you, Fana. Thank you, Asif. Thank you, Muhammad Salman, Adnan, Khalil, Hamza, Tufail, Niha. Guys, as of now, 29 participants is shown, but only a few participants is taking actively participation in this discussion. I appreciate you guys actively respond on that and take the participation. And by keeping that, I just appreciate if you guys now in the market, the many job seekers are there. You try to help them, try to explain them, try to support them for understanding the city law, the basis of one city law. They don't require to file the corporate tax return, but if they understand the basis of the taxation, the overall framework of the corporate tax, they might put in the interview to the interviewer the understanding. They know this is the fresher, but they will appreciate their understanding and their interest to learn the city also. Try to support the job seeker also in your community, in your circle, wherever you are. Let's move to the next. Here we already understand that the exempt income, local dividend, we already go through always exempt. If always exempt, the associated expenses will not be allowable expenses. If we already deducted, we will add back. Let's move to the point number 9, losses on taxable activities. Losses on non-taxable activities. This is the similar concept. This is the similar concept of this. Point number 8. Point number 8. Expense incurred on non-taxable activities. We said, okay, if income is exempt, so we will not deduct the expenses also.